I'm going to give you the specific threshold where hiring a financial advisor stops being optional and starts being the difference between retiring on your timeline or 5 years later than you planned. If you're a woman in your 40s or 50s with $1.5 million or more already invested, you probably know something is off. Your money's spread across a 401k, a Roth IRA, an HSA, and a taxable brokerage, and nobody's looking at them as one plan. Every time the market moves, you check your balance more often than you want to admit. You've been meaning to run the Roth conversion numbers, the Social Security timing numbers, can I actually retire at 58 numbers, and somehow year after year, you haven't. And every time you Google, when should I hire a financial advisor? You get an article written for someone 20 years younger than you. Here's what nobody will tell you. The answer is not when you hit a number. It isn't when the market comes down, or it isn't when the kids are out of college. These are the excuses high-achieving women in their 40s and 50s give themselves for 5 years too long and lose more to untaxed Roth windows, bad pension elections, and sloppy tax location than an advisor would cost them across a decade. The right time to hire a financial advisor isn't about how much you have. It's about how much complexity you're carrying, how close you are to retirement, and how much those decisions are costing you. The ones you're making wrong without knowing it, and the ones you're not making at all. I'm Hazel Secco. I'm a CFP and CDFA, and I run Aligned Financial Solutions, a fee-only fiduciary firm for women in their 40s and 50s who are the CFO of their household and the decision maker on their retirement. The women who reach out to me all ask me the same question. Is it finally time? I've had that conversation enough times to tell you the real answer isn't on a net worth statement. It's in the math of what you're carrying alone this close to finish line. Before we get into it, a quick note on the numbers you'll hear today. Every client scenario is composite. The figures are illustrative, drawn from real situations with identifying details changed. I'm giving you real answers, not vague ranges. None of them are a single client's file. Let me tell you why this question matters more in 2026 than it did even 5 years ago. 3 things changed. First, retirement runways got shorter and longer at the same time. If you want to stop working by 60, you might have 10 to 15 years of accumulation left and 35 to 40 years of withdrawal after. That's a longer retirement than most financial plans were built for, and a shorter runway to fix the mistakes you've already made. Second, the tax landscape is moving. The 2017 tax cuts expire. Roth conversion windows you thought you'd handle later may not be as generous in 5 years. The Secure Act changed how inherited IRAs work, and most women I meet are still running their parents' accounts under old rules. These aren't edge cases, they're the actual decisions in front of you right now. Third, and this is the one that doesn't get talked about enough. Most of my clients, they were making these decisions alone. They're single, they're divorced, they're widowed, or they're married to a partner who doesn't engage with their money. There is nobody at the kitchen table double checking the Social Security claim strategy or the pension lump sum election. That is structural risk, and it has nothing to do with your intelligence or discipline. It has to do with cognitive load. So when I say the right time to hire an advisor, I'm not asking when you feel ready. I'm asking at what point does the cost of carrying this alone, this close to retirement, exceed the fee of having someone who does this full-time sit next to you? That's the real question. And I have 3 specific pillars to help you answer it. Pillar 1 is what I call the retirement runway threshold. The mistake almost everyone makes is measuring readiness by net worth. I'll hire an advisor when I hit $2 million. I'll hire an advisor when the market settles down. That's the wrong metric. I've seen women with $3 million in assets and a paid off house who don't need an advisor. I've seen women with $1.5 million who are bleeding money every year because they don't have one. The right metric is a net worth. It's complexity multiplied by runway. And that has 4 specific triggers. If any 2 are true, you're past the threshold. 1, you're within 15 years of when you actually want to stop working. Not the traditional retirement, the age you're targeting. If you want out at 57, your runway is shorter than your friend who's fine working until 68. 2, You have 3 or more account types: 401k, rollover IRA, Roth IRA, HSA, taxable brokerage, pension, inherited IRA. Each one has a different tax treatment and withdrawal. The order you tap them in matters. Once you're juggling 3 or more, the coordination decision compound faster than a spreadsheet could handle. 3, you have $1.5 million or more invested and no written plan for how that money turns into income. Not a projection, not a fantasy, a written plan that accounts for taxes, inflation, long-term care, and sequence of returns risk. 4, you have a large, irreversible decision in the next 18 months. A pension lump sum versus annuity election, a social security claim, a Roth conversion window, an inherited IRA that has a 10-year clock you are already 2 years into. A home sale, a gift to adult children, any decision where I'll figure it out later is not actually an option. Let me give you an example. A woman, early 50s, $2.5 million across, all different kind of accounts, 401k, rollover IRA, an HSA, and a taxable brokerage. By the old metric, she was fine. She had a number. By the complexity times runway metric, she was 3 years overdue. When we ran her diagnostic, we found 3 things. She was 100% in target date funds across every account because that's what the 401k defaulted to. She had never thought about asset location, which assets belong in which type of account for tax efficiency. And she had an inherited IRA from her mother sitting in cash for 2 years because she didn't realize that 10-year distribution clock had started. Asset location alone in a portfolio that size can quietly drag 0.5% to a full percent a year of long-run net return. On $2.5 million compounding for 12 years to her target retirement, that's not a headline number. That's an accumulated miss. That changes what retirement looks like. But complexity is only half the picture because even if you're past the threshold, there's a question of whether you're actually going to act on the advice once you get it, which brings us to pillar 2. Pillar 2 is what I call the decision fatigue cost. Here's the mistake. Most women in their 40s and 50s measure the cost of an advisor in fees. 1% of assets, flat fee of $12,000, whatever it is. They look at that number and think, oh, I can do this by myself for free. And technically, they can. What they're not measuring is the cost of the decisions they're not making because they're exhausted. Every financial decision you make has 3 costs: monetary cost, time cost of researching it, and cognitive cost of carrying the question around in your head until you resolve it. The first 2 are visible. The third is the one that's killing the woman in her early 50s, running a team, a household, aging parents, adult kids, and a retirement plan on her own. And the way it shows up is not as a single bad decision. It shows up as decisions you never made. Like the Roth conversion you meant to do in the low income year, you took a sabbatical and didn't. The inherited IRA from a parent you kept in cash for 18 months because you didn't know the 10-year rule had started. Or the social security claim you'll think about at 65, even though the difference between claiming at 62, 67, and 70 can be 6 figures in lifetime benefit for a woman because women live longer and the math compounds. 4 would be the pension lump sum versus annuity decision with a 90-day window. Or another one might be the asset location inefficiency nobody ever told you was costing you money. Or the umbrella policy you know you need and still haven't bought. Let me give you another example. Late 40s, $3 million invested, salary plus bonus, 2 inherited IRAs from her parents, a non-deductible IRA with basis she had never tracked. The sum of the optimizations she had known about and delayed across 3 years once we added them up was meaningful. Not a headline number, permanently embedded in her retirement ceiling. Not because she was lazy, because the job she was actually hired to do was already a full-time job. The question isn't, can I afford an advisor? The question is, what is the cost of the decisions you're already not making, and how does that compare to a fee you'd pay once? That's the decision fatigue side, but there's one more pillar, and this is the one that actually determines whether you get value from hiring an advisor at all. It has nothing to do with what you know. It has everything to do with how you decide under pressure. Pillar 3 is removing emotion from the equation. Here's the mistake I see most often. And this one is not about what you don't know. It's about what happens when the market drops 20% 3 years before your retirement date. Or when a parent dies and you inherit an IRA you didn't expect. Or when your company offers you an early retirement package with 72 hours to decide. So in those moments, the question is not, do I have the information? The question is, can I make a clean decision when my own nervous system is running the math? The clients who actually retire on their own schedule aren't the ones with the highest balances or the best spreadsheets. They're the ones who built a system for making big decisions before the moment got big. They took their own emotion out of the driver's seat at the exact points where emotion would have cost them the most. 3 moments where this matters most for a woman within 15 years of retirement. 1. A market correction 5 years before your retirement date. Without a system, you move to cash at the bottom and miss the recovery. With a system, you rebalance and your retirement date doesn't move. 2, a parent dies and an inherited IRA lands in your lap. Without a system, it sits in cash for 2 years while the 10-year distribution clock burns down. With a system, you map the drawdown against your projected tax brackets each year, fill in the brackets where they're cheapest, and turn a grief fog decision into a tax-efficient one. 3, a severance or early retirement offer arrives within 72 hours to respond. Without a system, you take the number that feels biggest. With a system, you calculate the expected value of the lump sum versus the pension, run it against your expected longevity, and negotiate from the answer, not the adrenaline. An advisor is the system. That's what you're paying for. Portfolio management is table stakes. Tax loss harvesting is table stakes. You're paying for the person who is not emotionally involved in your money to make the call with you in the exact moment your own judgment is compromised. When was the last time you made a 5-figure financial decision when you were tired, stressed, or emotionally activated? And do you know, honestly, how that decision turned out? Another client example. Early 50s, called me in a 2025 correction. She wanted to move 40% of her taxable brokerage to cash. We got on the phone call for about 22 minutes. I asked the 3 questions I asked every client in that moment. She didn't sell. 6 weeks later, the portfolio was meaningfully higher than where she'd wanted to exit. The difference wasn't a trade. It was the person on the other end of the phone who wasn't emotionally involved in her money. That's what you're actually paying for. The right time to hire a financial advisor is not when you hit a net worth number. It's when any 2 of these 3 are true. Your financial life has crossed the retirement runway threshold. You're within 15 years when you want to stop working. You have 3 or more account types. You have $1.5 million or more invested. You have a large irreversible decision in the next 18 months. 2, the decisions you're not making because of cognitive load are already costing you more than a fee would, compounded across the runway you have left. 3, you've made a significant financial decision in the last 12 months while emotionally activated and you're honestly not sure it was the right call. If 2 of those are true for you, you're not maybe ready, you're behind. And after 50, the math of being behind gets worse every year, not better, because the recoverability window closes. Retirement runway threshold, decision fatigue cost, removing emotion from the equation. Those are the 3 pillars. That's the real answer to when to hire a financial advisor. If you want me to walk you through these 3 pillars with your specific numbers and tell you honestly where you stand, the link to book an Align call is in the description. 1 conversation, no pitch. You'll leave knowing whether you're ready, overdue, or genuinely just fine on your own. I'll see you in the next episode. Keep living wealthy and live well.